$1,048 a month. That's what one family in Maumelle was losing every single month by protecting a 3% mortgage rate. Not saving, losing every single month. And I know exactly how that sounds because there is one piece of financial advice that has gone completely unquestioned in this country since 2022. And it's this: never give up a low rate. I tend to follow that same thought process originally, but let me question it. I also live in a house in Maumelle with a rate under 3%. And so why would I give up that rate, right? Why would I decide to sell this house and give up that incredible rate that I have on this particular property? If you bought or you refinanced when rates were in the twos and the threes, you are also probably carrying some other balances, credit cards at 22%, maybe a car note at around 7%, maybe a personal loan or a HELOC at 6 or 7. And you're not protecting that low rate because you've got these other obligations that are at a much higher rate. You're using your low rate as that excuse to keep paying a very high one or higher ones. And the money that you can use to fix that is actually already yours. It's sitting inside the walls of your house, just hanging out, doing a whole bunch of nothing. So I'm Amanda Galbraith. I'm the broker owner of Arkansas Property Management and Real Estate. And I have been doing this here in Central Arkansas for a little over 16 years. And in the next few minutes, I am just going to put 4 options on the table for you with real live numbers at today's actual rates. One of them saved this family $1,048 per month and lets them keep that 3 to 5% interest rate. So let's get into it and talk a little bit about how in the world this could even be possible and if it is in fact the right fit for you. Okay, so most people don't know that all of these options even exist out there in the world. Nobody's out there advertising to you either. And about 8 minutes from now, I'm going to tell you exactly why and how you can leverage what you already have to solve some of your financial woes. So are you ready? All right. So let's go. Let's get into it. So this is what happened really to all of us during that time period when rates were in the crazy numbers that they were that I don't think we'll ever see again in our lifetime. But for about 18 months to 2 years, mortgage money was the cheapest it has ever been in American history. And if you locked a rate in that window, you got a genuinely once in a generation deal. That was real. It was true. It was a fact, and it's still real. We are never going to see those numbers ever again. But somewhere along the way, the mortgage rate stopped being one number or the overall number in a financial picture. And it became the entire financial picture. It became people's identity. They were out there taunting it with the number that they have, almost wearing it like a badge of courage. People introduce themselves to me, by their rate sometimes. Oh, I can't move. I've got 2.75%. Like that's literally wearing it like a badge of courage. And I understand that because I do too. Believe me, I have a 2.75%. But based on your family circumstances, there can be some flaws in that logic of just saying, I'm never moving or I'm never doing anything because I have this super low rate. So your mortgage rate is the interest rate on just one debt, your house, right? So for most families, it is the lowest rate they carry on the largest balance, no matter what your rate is, which sounds wonderful. And it is, that's a good thing. But it also means that your mortgage is the debt you're paying the most attention to, right? And the debt that is hurting you really the least. You have to pay to live somewhere, right? So that debt it's going to happen no matter what, right? But meanwhile, the debts that are actually eating you alive and eating all of your cash flow are sitting off to the side, and really nobody's bringing those up around the Thanksgiving table. Nobody's wearing that, Amex percentage around like that baggage of courage. So let me just say this as plainly as I can. Nobody has a 3% mortgage, and that's it typically. Now, unless that's the only debt you carry, you have a 3% mortgage and a 22% credit card balance. Those are not two separate situations. That's one balance sheet at the end of the day. And what matters at the end of every month is not the rate on line one, it's the total number that leaves your checking account, right? It's that total number that you're paying out every month. Okay, now, just a really quick pause. I need about 20 to 30 seconds, and then I promise we're going to get straight to those actual numbers that affect you and your family to help you make this decision. So, two things. One, if this is already making you just a little uncomfortable, go ahead and hit that like button. That's genuinely how this video gets in front of the person who needs to see it. And I bet you already know that person, who they are. You could name them right now. So go ahead and make sure you hit that like and subscribe button for us to make sure you get some more content. Two, if you're sitting there wondering just how much equity that you have to play with inside the walls of your home, then just comment in the word equity down below. Just hit that comment button and comment the word equity, and we'll send you over a free equity report. No pressure, no sales, just so you kind of have a better idea. Just the word. I'll send you that free equity report. And I don't mean your Zestimate on Zillow, because Zillow doesn't know about your kitchen. It doesn't know that you redid the bathroom. It doesn't know what closed on your street last month that was an off-market property. These are actual real comparable sales and actual estimated net proceeds from what your house would realistically gain either from a sale and or for rent. And that last part really matters, and you'll see why as we go through the video. So comment equity and subscribe to the channel, because I will give you stories like this and math like this every single week that's specific to our location right here in Central Arkansas. Okay, so let's get to it. Everybody wants to hear the numbers. Let's get down to the real math behind it. I'm going to walk you through a full composite. So this is not one specific client, if you will. It's a blend of a conversation that I've had, gosh, I don't know, probably 30 to 40 times in the last 2 years. The numbers are truly realistic for our exact market right here in Central Arkansas. So let's take a 3-bedroom, 2-bath house in Maumelle, and let's say that you purchased that property in 2021. So today it's worth $385,000. The mortgage balance is $210,000 at a 3.25%. So if we take that information, the principal and interest is going to run you about $1,045 a month. Taxes and insurance, you're going to have to add on top of that, of course. So let's call that $420, and we get to a total house payment or coming out of your checking account every month at $1,465. Again, rough estimates based on some data. That is a fantastic house payment, $1,400 in 2026 in this market. That payment is truly a gift. If you told me to go find you that same house, Maumelle, 3 beds, 2 baths, I can't do that for you at $385 and get you a $1,400 house payment unless you've got a pot of money sitting over there. So let's talk about the rest of that page for just a minute. So we've got that $1,400+ house payment. We've got some credit cards, $28,000 at 22.9%. That's a pretty average credit card rate. The minimum payments of $780 a month. Then you've got a car loan, $32,000 at 7.4%. $645 a month. So we got about a $650 car payment. Then you took out a personal loan, I don't know, maybe to do some renovations or to take a trip for $15,000 at 6.5% interest. So that's $340 a month. So now we're to $75,000 of non-mortgage debt, meaning it's not attached to your home in any way. And that's costing them about $1,700-ish, 1,750 a month just to service that debt. So we're really not even including a whole lot of paying down that debt. We're just servicing it. So 2 monthly outflow. Okay, we've got the two together. All that total, the secondary debt plus the mortgage debt together, gets us to $3,230. So $3,230 a month. And I want you to sit kind of with that credit card line for a second, because this is the part that, makes me want to put my head through a wall sometimes when I'm talking to folks, is that's really the payment we're looking at, the $3,230, right? Okay. So $28,000 at 22.9%, the interest alone on that balance, just the interest, is about $535 a month. And the minimum payment will run you somewhere in the number of $750-ish per month. So really kind of sit and marinate with that, because what we're going to focus on is how we can eliminate that and get you to a house that you really like. Some of that $780 that you're sending every month, roughly $535-ish is interest, and then $245 actually does go to reduce the balance. So we are reducing the balance a little bit, assuming that we're not then recharging that every month as well. So let's assume for a minute that we're not charging anything else. We've cut the card up. We don't have access to it. At that pace, assuming you never charge another dollar on that card takes more than 8 years to pay off that balance. And let's just assume that you never charge another dollar. That the likelihood of that is not great. Okay. So we call that not really debt. We call it subscription. Okay. You're renting money, if you will, at 23% for an indefinite time period from now until eternity. And they have $175,000 in equity hanging out in these four walls, just hanging out, living pretty. Okay. And it's doing nothing at all for you. So let's talk about some options. Option one that we're going to talk about that everybody always thinks about first is a cash out refi. Everybody always goes there first. It doesn't really matter who you are. It's always the option that I hear come out of someone's mouth very first time. We're going to take a new loan. We're going to pay off the old one. We're going to wipe out all that other debt, and we're going to end up with one payment on the current house. That's an option. It's the one that I hear most frequently. The existing balance is, remember, that $210,000. We've got that debt payoff of $75,000, and we've got some closing costs that'll go along with that. I mean, it's not free to refinance your house. So we're going to call it $8,000. That's probably too much, but we're going to go with that. So now we've got a new loan that's at $293,000. Okay. On a $385,000 house, that's about 76% loan to value, which 1,000,000% works. Absolutely. Most cash out programs do cap you at right around 80, but we're well below that threshold. So option number one, 1,000,000% works. Okay. So here's where I want to be brutally honest with you. Okay. And where a lot of videos on this topic kind of, we'll say cheat in silence or quietly cheat the numbers. Cash out refinances do not price at the headline rate that you see on the internet. So if you go on and you look at Mortgage News Daily, you look at today's rate, that's not the rate for a cash out refi. Okay. So a cash out refi for the lender is a riskier loan. Okay. So it carries what's called a pricing adjustment. And today the average, right, 30-year refi is running about 6.78%. And again, this changes every day. For a cash out at that loan to value, you should budget somewhere around 7 to 7.25. So between 7 and 7.25. $293,000 at, let's go with 7.125%, is $1,974 a month in principal and interest. And add back the $420 in taxes and insurance. Okay. So we took our principal and interest, our taxes and insurance, we're adding those back together to get our new total, or our new monthly cash coming out of our checking account, at $2,394. Now let's compare that to where we started. So we've got $2,394 over here, Okay. So the mortgage payment went up. It did. Okay. It went up by, $929 a month. So a little over $900 a month. We increased our mortgage payment. Okay. But the total that we were spending every month out the door, the total monthly obligations actually decreased by $836 a month. So because we paid out all that other debt that we were servicing, we've decreased our monthly outflow. That's $10,000 a year, by the way. Okay. They went from 4 payments every month to 1 payment every month, and their credit utilization falls off a cliff, which in most cases will pull your credit score up a lot, sometimes 30 to 80 points within a couple of billing cycles, because, part of your credit score is looking at the ratio between the amount of credit you have available and the amount of credit you're using. So yes, this person gave up the 3.25% interest rate all day. They did. That happened. They took a 7.125% rate, and they got $836 a month to the good. They're saving that much money. That's the entire point of the video. The rate is not the payment. The rate is one input into your monthly payment. Now, you do have to be disciplined. You can't run all that credit card debt back up, right? You can't do that. But if you can be disciplined enough to not do that option does work. Okay. But hang on for just a minute, because I'm not so sure that is the best option. It might be for you. That's why I'm giving you lots of choices here. This is the part that I promised you, that there's more than that one option. There's more than a cash out refi. Okay, that's just what most people think of first, but there's actually more choices. So everything I just showed you assumes you have to give up the low rate, but you might not have to give up the low rate. Okay, you might not have to. So let's talk about another option. Option number 2, if you will. And for most people in this exact situation, you got to be in this exact situation. There is something called a home equity line of credit, or a HELOC, which is a fixed rate home equity loan. Same concept applies here. Okay. But here's the one difference between the cash out refi and this HELOC, or this line of credit that we're going to talk about against your house. A cash out refi replaces your whole existing mortgage, right? You gave up that 3% rate, and we now have a whole new mortgage in place on your property. We're starting that 30 years over, if you will. Okay. Your entire $210,000 balance actually got repriced from that 3.25 all the way up to the 7.125. So the whole big picture got repriced. But a HELOC actually doesn't do that. So on that balance that you currently have, that's going to stay priced at whatever your original rate was. So we're going to stay in the 3s on that balance. So a HELOC doesn't do that. A HELOC sits behind your existing mortgage. Your first mortgage actually doesn't move. It stays in place. And that 3.25% stays exactly where it is on that full balance, untouched. You only are borrowing against that equity. Remember that money that's sitting in the walls that was just hanging out doing nothing? That's what we're actually borrowing against. So in our scenario, that was $75,000 that we needed, right? So a HELOC rate right now are averaging somewhere between 7.5% and 8.33%. Lots of factors there as to how those are priced out. So let's just kind of use the middle. Let's use 8%. That's pretty conservative for most folks. And let's structure it to fully pay off over 15 years and not 30, because you don't want dragging this credit card balance behind you, for 3 decades. That's not necessarily super smart. So let's try to pay that off in 15 with that HELOC versus a 30, especially if you've been in your house for a while. We don't want to drag that HELOC out longer than your traditional mortgage. That doesn't really make sense. So $75,000 at 8% over 15 years is $717 a month. So let's go back to what we talked about. Our existing house payment, right, that we got back in 2021 is $1,465, and that stays that way. It's untouched. Okay. Plus we've got this HELOC balance over here that is $717. So now together, as we merge those two payments, we're at $2,182. So $2,182 a month. So now let's compare where we started with that house payment and all that credit card debt. And we are $1,048 a month better off than when we started. It's $212 a month better than the cash out refi. The debt's gone in 15 years instead of 30. Closing costs are a fraction of a cash out refi, sometimes zero, depending on where you're getting the money from. And you keep your 3.25%. So you can still wear that with your big badge on it right here, 3.25. So here's the question. Why are people not running to the bank to do this? Well, two reasons. And the first one is totally legit, right? Most HELOCs are variable rates. So the payment can do this on you. It can. It's a real risk. I'm not negating that. Most HELOCs are variable rates. And that's sometimes why some people should take a fixed home equity loan instead, even at a slightly higher rate. It depends on your particular situation. Everybody is not the same. The second reason is the one that I promised you way back in the top of the video, is that no one is advertising this out here to you because the commissions on HELOCs is a rounding error compared to refis. I mean, the banks aren't making boatloads of cash on HELOCs. They just aren't. It's not a conspiracy. It's just incentives. It isn't, right? Like it would, but you deserve to know that that option exists because in this scenario that we're talking about today, that's the number that wins. Again, your situation is independent to you, but it definitely won on this client situation. Okay, now guess what? There's a number one. There's three, actually. This one gets me lots of strange looks at different luncheons and events that I attend when I tell people about it. Sometimes the right answer is to sell your current house and rent for a while. I know, take that in. It's very counterintuitive, and I get it. I am a real estate broker telling you that renting might actually be a smarter move. Okay. Now, I also manage more than 100 rental doors in this market. So when I talk about the true rent costs, I'm not guessing. I'm reading my own rent roll that we process every single month. Okay. So let's take this as option 3 and let's talk about it and let's run these numbers to see what this scenario looked like. Okay. So here we go. Let's do this together. This is option 3. So we're going to sell at $385,000. The cost of the sale, let's talk about 7% in terms of we've got commissions, we've got closing costs, we've got concessions. It's about $27,000. So net proceeds are going to be right around $358,000. That's what we're going to assume for a minute. Okay. So we're going to pay off our mortgage. Remember, we had that 200-ish balance. That leaves us $148,000. So we've got $148,000 to play with. So we're going to pay off all of that big chunk of debt. Okay. Remember, we had the credit cards, we had the car loans, we had the personal loans, we had all that stuff. We're going to pay it all off. And that leaves us with $73,000 in the bank, liquid, sitting there in a savings account, zero debt, except for whatever we're going to pay for housing, because we do still have to live somewhere. Okay. But we were paying a monthly payment anyway, right? We were paying whatever it was, $1,400-something a month to just live. So we're going to have to do that again. Okay. So now you're going to rent a comparable, let's just call it a 3-2 in Maumelle. It's going to run you, let's call it $2,000, $2,100, depending on the age and the finishes and all that. So might could even get it a little bit less for that, but $1,950. So let's call it $1,950, $1,975. So you went from $3,230 a month, $3,250 that you were paying out, to $1,970, call it $2,000 if you want to. That's $1,260 a month less. Plus, you've got $73,000 sitting in the bank. So you're paying about, even if you just round it to $1,000 a month less, and you've still got $73,000 sitting over here. So this is the part I really want you to hear, and the part that I think most about really when I sit down with clients to evaluate their total financial situation to see what makes most sense for them. When you rent, the roof, not your problem. It leaks, you call us. If that 2021 purchase came with a roof that was I don't know, even already 15 years old, maybe it's only 10 years old, an HVAC system that was older, and now we're 5 years down the road, a water heater from a decade before. You're sitting on a bill that simply just hasn't shown up yet. And you've got all this credit card debt sitting there. You're just waiting for one of these things to go out, because that's what happens. Time will do that to you. So if we're replacing a roof right now in Central Arkansas, depending on the size of the roof, that can run you somewhere between $10,000 and $20,000. An HVAC system is $9,000 to $15,000. A water heater is usually somewhere between $1,800 to $2,250. So we're talking about somewhere in the range of $29,000 and $45,000. I mean, it's a big range. So $30,000 to $45,000. That's going to happen. It's scheduled. Whether it's on your calendar or not, those things are going to have to be repaired and or replaced sometime soon. So here is the really cruel part, if you will. So let's think about this family that's in our scenario that we've been talking about this whole time. It's carrying $28,000 of credit card debt. When that HVAC dies in the last week of August, and it's going to die in August because that's when things happen, and it's 105 degrees outside, what is the plan there, right? You've already got all this maxed out credit card debt. What are you going to do? They're going to put it on another credit card, or they're going to get a financing situation to finance the HVAC at 22.9%, because that's how that happens, because you don't have $15,000 sitting there to replace the HVAC system. Okay. And we're right back where we started, or even worse, because now we haven't paid off those credit cards and we're just adding to it. So that's that loop of riding this wave that I'm trying to help people get out of. High interest debt plus aging major systems is not two problems. It's actually one. And unfortunately, it's a problem that begins to compound, over time. So speaking of which, if you want to know, if you're curious now and you want to know what your house might actually be worth for any one of these scenarios, you need to know that after your net cost and maybe what it would rent for. Then comment the word equity below. Remember, hit that comment button, type the word equity. I'll build that report to you at no charge, no pressure. We'll send it over to you. Takes us about 30 minutes to an hour, and it literally costs you nothing. So just comment equity below, like and subscribe to the channel as well to get more info like this. But you need to know the true equity position of your home to look at all three of these options. Whether option 1, 2, or 3 is best for you and your family, you need to know that equity. Okay, I have spent 12-ish minutes showing you the upside. Now I'm going to spend a couple, maybe 2 to 3 minutes showing you how this could blow up, because if I don't, it's a disservice, because it could blow up. It's not the end all be all for everybody. So risk number 1, and this is the greatest risk. It's a true factual risk. Credit card debt is unsecured. It's a terrible debt with a terrible rate. But if your life falls apart, you lose your job, you have a major medical event that's not covered, you unfortunately get divorced and you don't know it's coming, unsecured debt can be negotiated, settled, restructured, or discharged. Nobody is going to take your house over your American Express or your Visa balance. That's 1,000,000% true. The moment you take that debt and you turn it into your mortgage through a cash out refi or a HELOC, it becomes secure by your home. That is now secured debt. And you have converted a debt that could cost you your credit score into a debt that could cost you truly your home, where the roof over your head. That's an honest to God risk. So you really have to be 100% brutally honest with yourself about the stability of your income before you make these trade-offs. If your job is shaky, or you feel like that ground is shaking, this is probably not your move, no matter how good the monthly math looks. Okay. Or maybe option 3 is the best for you, where we're renting. Risk number 2, if you don't change your behavior of charging things on this card, it makes everything just worse. Like I said before, you can't go out and recharge all these cards to $20,000 after you refi or do the HELOC or you sell and move. I've watched people wipe out, $25,000, $30,000 in credit card debts using equity and have, $15,000 to $18,000 back on those same cards in 2 years. Don't do that. Now they've got higher housing costs and they've got those credit card payments. That's not a math failure. That's not because the math didn't math. That is a habits failure, and no refi on earth fixes that. You've got to fix you and your spending habits along with doing one of these other things. So if you do this, my best advice is to close those accounts or freeze them. I'm serious. Cut them up, get rid of, close the accounts. Do not have access to them. Unfortunately, credit is super easy to access in this country. Risk number 3, and this is the honest asterisk on everything I've shown you today. So number 3, stretching $75,000 of that consumer debt across a 30-year mortgage does mean you'll pay far more total interest on that $75,000 than if you attacked it aggressively over 5 years on those credit cards. The monthly number improves dramatically. The lifetime number could get worse depending on the situation. It's why we have to really be honest when we're talking to clients and make sure that everything is laid out on the paper. So here is how you can fix that. Okay, risk number 3, take the savings and put it back to work. So in our cash out example, we freed up $836 a month. If you sent even half of that, $400 back to the new loan as an extra principal only payment every month, remember it's principal only, that you can cut years off of your mortgage term and tens of $1,000s off of that interest. And you still have an extra $400 a month of just breathing room, extra cash flow that you didn't have before. But paying down that principal is super important. So it's the savings is not a raise. You can't use that as, oh, I got an $800 a month raise. You were already spending it, put it to good use. It's a tool and you need to use it as a tool. Okay. All right. So risk number 4, closing costs on a refi, cash out refi runs $6,000 to $10,000. If you're planning to move within, 2 to 3 years, you will not recoup that. So don't do it. Again, why honesty really matters when we're having these conversations about your future plans. And then finally, risk 5, HELOCs are variable. Most often they are variable interest rates. So if we see rates go up, guess what? Your payment goes up. If that $50 a month is going to break you, take the fixed option, even if it costs a little bit more. Sleep is worth 1/4 of a point, believe me. Okay. So how do you figure out if any of these options, either of these 3 scenarios, applies to you? So we can do it at your kitchen table. Okay. There's really 5 steps that you need to know. Okay. Step 1, you've got to write down every single debt that you have. We need to know the balance, the interest rate, the minimum payment. Literally everything: cards, cars, student loans, the furniture, the sofa you went and bought and financed that at 0%. Okay. All of that stuff, the medical bill that you're paying $25 a month on, all of those things go on this spreadsheet, every one of them. All right. So step 2, add up the monthly payment. Okay. That's step 1, not the balances. We're talking about the payment. What is actually going out of your checking account every single month? Okay. That total is what we're going to call the real number. So most people have never written it down. They don't really know. And it's almost always bigger than what they think. The shock on people's face when they see that number happens almost every single time. Okay. Because they think of those payments in small increments, not as one chunk. All right. Step 3. Find out what your house is actually worth today. I told you, not the app, not the Zestimate, but the real number. Knowing your true equity position is the only way you can determine if any of this applies to you and then which option is right for you. It's the only way you can do it. Common Equity will get it to you. Step 4, call an actual lender and ask them to price all 3 choices: the cash out refi, the HELOC, the fixed home equity loan. Ask specifically what the cash out pricing adjustment is. That's important. If they only quote you one option, you're going to need to call somebody else because those are not the same. Okay. You need help finding those people? Ask us. We're happy to help. Step 5, compare your total monthly outflow, what's actually going out, not rates, not payments, the total outflow, today's number against each option's number. So we're going to have the today going out, option 1, 2, and 3. Then we're going to check the lifetime interest on each. So you're going in with eyes hugely wide open, but we want to see current and then each option. And listen, it's entirely possible that you run all of this, and the answer is to stay put, keep your 3.25, and attack those credit cards with a balance transfer, maybe a budget option. It's a real outcome, and sometimes it's the right one to just stay put. But you need to know what your options are and that you have options. I'm not trying to talk you into a transaction at all, because the real value may be to stay put, but I am trying to talk you into just doing the mathematics, because most people in this situation have never done it. They absorbed a rule, never give up a low rate, wear it with that badge of honor, and they never once checked whether that rule applied to them or not. So here is what I'm going to ask of you. If you have a rate that starts with a 2 or a 3, and you also have some credit card balances that you're not particularly proud of, I get it. I want you to write down your total monthly outflow before you go to bed tonight. That's it. Just the number. Just figure out that step one. What is the number that's coming out every single month? Okay. If that number surprises you or scares you or shocks you or makes you go, ah, then you owe yourself an afternoon of real math, and we're here to help you do that. Okay. If you want the property side handled for you, comment the word equity below. We'll get you that started so that then we can help you make that comparison of your current situation and then options 1, 2, and 3 to see really what makes the most, and 4, which is to stay put, I guess, and make sure which one makes sense for you. Okay. We'll tell you what your property's worth, how much you would net, what it would rent for, what the deferred maintenance realistically might look like. So no pressure, no pitch, no obligation. Just want you to be able to see the true math in front of you to make an informed decision for you and your family. That's what's most important. Hit the like button so this reaches somebody that you know who might need it. Subscribe so you can catch next week's episode. And if you know someone who's stuck in exactly this same spot, send it to them. This is a video I wish more people had seen in the last couple of years so that they know that they have options. One important note before I let you go, I'm a licensed Arkansas real estate broker. I'm not a mortgage lender, I'm not a CPA, not a financial advisor. I am a real estate broker. Every number in this video is just an illustration based on today's average published rates and families I've actually worked with. Your situation will be different for this one. So run your actual numbers. Talk to a licensed lender. Talk to a tax professional. You need some people on your team. I am one part of that team, but there's lots of people that go on this team. Okay. And we've all got to be playing together to win you the game, which is the game of life. So Arkansas Property Management and Real Estate, we are 501-851-7771, www.ar-property.com. You can check us out there. And I will see you guys next week.